take out your handout. I want us to discuss on accounting for assets and liabilities. Handout page 21. Handout page 21. Now, for accounting for assets and liability, this one will comprise of 20 to 35 marks of your exams, of which, though we have discussed most of them, such as the income taxes, the leases, borrowing cost, all that, financial instrument, employee benefits, all that. Now let's start with investment property. And that one is provided under IAS 40. And what's an investment property? Now, investment property, these are assets held, number one, to earn rental income or for capital appreciation, rather than used in a day-to-day activities. I repeat again, this is an asset held, number one, to earn rental income or for capital appreciation or both, but not used on a day-to-day operating activities, e.g. land, also building. If the company acquires a land, of which they expect to use it in the future, they are not using it now. So that means they are holding that asset. Either number one, they can lease it to another party, or they decide not to lease, but they hold that asset for capital appreciation. Now, that's what we call an investment property. A company can construct a building and then they rent it out to other parties. So that means in this case, the company will be earning the rental income. That's what we call an investment property. Now, what's the difference between IAS 40 and IAS 16? Now, IAS 16, it's on PPE, plant, property, and equipment, of which a rented building, they also falls under IAS 16 PPE. When does land or building qualify to be an investment property and not a PPE? Just a minute. Qualify to be an investment property, but not a PPE. Now, PPE, those are assets used on a day-to-day operating activities. If the company acquires a land and then they start using that land, that one is not an investment property. That one is part of PPE, plant, property, and equipment. If the company constructs a building and then they use it as for the admin purposes, rather than earning rental income, that one is not an investment property. That one will fall under IAS 16, under PPE. So for it to be an investment property, number one, must be held to earn rental income or capital appreciation or both, rather than used on a day-to-day activities. Go back to our notes. So you're saying that investment property. Now, these are assets held to earn rentals or for capital appreciation or both, rather than used in the production, supply, and administration in the ordinary course of the business, e.g. land and building. So what are some of the examples of investment property? One, land held for long-term capital appreciation rather than short-term sale in the ordinary course of the business. Number two, land held for predetermined future use. C, a building owned by the entity or held at a finance lease by the entity and leased out. Also a building which is vacant but is held to be leased out under one or more operating lease. Also property that is being constructed for future use as an investment property. What are some of the property which are not considered as an investment property? One, land held for the ordinary use by the entity. Ordinary use means what? Ordinary, they use in a day-to-day operating activities. Then number two, building held for use rather than capital appreciation or to earn rentals, as well as asset held for the normal use. That means any asset held for day-to-day operating activities does not fall under investment property. How do we measure investment property? Measurement and recognition. Now, in this case, we have the initial recognition. And number two, we have subsequent. Now, initially, all assets should be recognized at fair value or cost. If you buy a building or if you buy a land at 3 million, initially, that's what you show in the financial statement. So that means initially recognize an investment property or any form of other PP at cost. Then subsequently, you measure them at fair value. Fair value means the market value, or at amortized cost or the cost model. Cost model, that means you take the original cost minus any depreciation or impairment. As simple as that. So we look at initial recognition. Now, initial measurement. Investment property shall be measured at cost. Can you underline that? At cost. Initially, we measure the investment property at cost. Cost shall include the purchase price and any other direct attributable cost incurred on acquisition of investment property. Yeah, that means you also capitalize all the preliminary expenses, yeah, including the conveyance, the cost you incurred in the process of raising fund or in the process of buying that asset. Then subsequently, an entity shall choose either the use of, number one, you can use the cost model. Now, cost model, that means you take the original cost minus any accumulated depreciation or impairment, or use the fair value or revalued model. Fair value means that you revalue the asset. For example, if you take a component of land does not depreciate, right? But the value appreciates. So how to determine the value have appreciated? You have to value that asset. And to value, it's all about taking into consideration the effect of the current market value. That current market value is what we call the fair value. So number two is the fair value model. Under this fair value model, investment property is measured at the end of each reporting period. Any fair value gain or loss shall be disclosed and reported to profit and loss account during the period they arose. Yeah, that's why you have what we call a revaluation gain or a revaluation loss. And that one affects the statement of comprehensive income. Good. Recognition criteria for investment property. When should you recognize an investment property? We discussed this under IAS 41. What was IAS 41? Agriculture, right? Yeah, when should you recognize a biological asset? When you own and they control the asset. Number two, when you expect some future economic benefits. Number three, when the value can be measured reliably. The same applies to all the other assets, including the investment property. You should recognize an investment property if the company owns and controls the asset. Number two, when the value of that asset can be measured reliably, and when the entity expects some future economic benefits. Yeah, so you think that investment property shall be recognized as an asset when, number one, it's probable that the future economic benefit will flow from the asset to the entity. Number two, the cost of the fair value of the investment property can be measured reliably. And number three, the entity controls the investment property. You can write in bracket owns. Also owns. Good. So that's all about investment property. Now let's discuss IAS 16. And that's PPE, plant, property, and equipment. Yeah, building, furniture, fittings, all that. They are what we call also computers. They fall under IAS 16. That's what we call the plant, property, and equipment. So IAS 16 PPE outlines the accounting treatment for most type of PPE items. It further stipulates the principle for recognizing property, plant, and equipment as an asset, measuring the carrying amount, and the depreciation and impairment losses to be recognized in relation to them. PPE are initially measured at its cost, and write that at cost. It's the same as on how we account for investment property. But initially, you recognize them at cost. Then subsequently, you measure them either at cost. That means when you talk about the cost model, check the cost minus depreciation, or the fair value model, or the revalued model. Yeah, PPE are initially measured at cost, subsequently measured either at cost or revaluation model. Good. So what are some of the disclosure requirements for PPE? Disclosure requirement. Now, when preparing the financial statement, either to the statement of income, statement of financial position, or to the notes to the financial statement, what are some of the disclosure requirements you need to show? One, saying that the following information should be presented in respect of item of PPE. Number one, the basis of measuring the carrying amount. What is carrying amount? The net book value. But you see that carrying amount is the amount shown in the financial statement. In short, is cost minus accumulated depreciation or impairment. That's what we call the carrying amount. Number two, you need also to show the depreciation method used and its rates. Number three, useful life of the asset. We are using handout, and we're in handout page 22. Number four, the gross carrying amount, the accumulated depreciation and impairment losses at the beginning and at the end. Then number five, a reconciliation of the carrying amount at the beginning and at the end. And that's what we call PPE movement schedule. Yeah, where you factor in the opening balances, you add any addition or the acquisition of the asset during the year, you add any revaluation gain for the year, you raise accumulated depreciation, you also factor in depreciation for the year, impairment, disposals, and then you get the adjustment at the end. And what you get after adjustment is now what you take it to the balance sheet as part of PPE. That's what we call the PPE movement schedule. Good. Yeah, we're saying that number five, a reconciliation of the carrying amount at the beginning and end. That's what we call the PPE movement schedule of the period, showing number one, the additions, the disposals, also assets classified as held for sale, as well as the impairment loss and reserves of impairment. NB, derecognition. What do you mean by derecognition? Okay, what is recognition? What is recognize? Sorry? Sorry? When recognize is that you okay, financial statement. That's what we call recognition. When you recognize it to the financial statement, you are correct. To recognize means to do what? To show. When I recognize you, what does it mean? To recognize the presence. Yeah, so that means recognition is that inclusion of the financial an item in the financial statement. Therefore, what is derecognition? It's to remove. Are you together? Yeah, derecognition is the removal of a previously recognized financial asset. Now, when should the company derecognize or remove an item of PPE from the balance sheet? Number one is when you dispose their asset, correct. When you dispose the asset, you remove that asset. That's what we call derecognition. Number two, when is? Yeah, when the asset is obsolete. That means you don't expect any future economic benefits. And number three, when the asset has been fully depreciated and the company does not expect to earn any future economic benefit. So we are saying that the recognition of an item of PPE is done on disposal, and in that disposal, or when no further benefits are expected from the use or disposal. That means when the asset is obsolete. Good. Then you have disclosure requirement for PPE stated at revalued amount. Revalued amount is fair value. That's what we call the revalued amount. Now, when you revalue an asset at the end of the year, an item of PPE, let's assume land or building. Now, you see, the values will be shown in the statement of financial position. What about some of other disclosure requirements? Other disclosure requirements, we'll come to discuss that later in our next topic. We have another financial statement known as the notes to the financial statement. So what do you disclose to these notes to the financial statement? Now we are looking at disclosure requirement for PPE stated at revalued amount. Number one, the carrying amount of PPE, you need to show how much was the net book value before revaluation. Number two, the changes in revaluation. I need to show what we call the revaluation gain, revaluation losses. Also, disclosure of specific accounting policy and effective date of revaluation and whether an independent valuer was involved. Now, those are 3 points. Point number one is what? The accounting policy used. Number two, the date of revaluation. You can revalue the asset at the beginning of the financial year or at the end of the financial year. Also, you also need to show whether you engaged who? An expert. Are you together? Because an independent valuer value is more reliable even to the auditor as compared to revaluation by management. Can an accountant value a land or a building? You know you are an accountant. Once you angalia building, uiangalie hivi useme inakaa it's like it's worth 50 million. Can an accountant do that? No. So an accountant is part of the management. Sometimes the management can revalue an asset, not when they are fair, but they want to reflect a given objective. They want to show that they have a wider asset base. So that means when valuing the asset, they give it a wrong value, which has been inflated. So when disclosing this information, you need to show that whether you engage an independent valuer. You need to engage, okay, who values the property? Surveyor ni kazi yake ni kupima. I think I've already said, So the valuers, yes, you need to engage a professional valuer. Yeah, for valuer, they look at things. Yeah, number one, okay, we'll come to discuss about on IFRS something. That's IFRS 13 on fair value model. When you're measuring something using the fair value, we have some 3 input forward. Number one is what we call the observable things. Unaangalia tu kwa macho. Number two, we have level 2 input. You look at observable items. If you're buying a rod, for example, you see number one, you see the rod, and then you look at the structures around it. Number two, look at unobservable. You ask the neighbor, kukinyesha huwa kuna flood. Are you getting? Those also are some of the things you need to consider. Then unauliza another one, unaenda kwa chief. Chief, kulingana na hii area, na ile map iko. Wewe umesikia serikali kuna venye imesema itaiweka kiwanda hapa ama kuna barabara itapita. Those are the things that you cannot observe using your eyes, right? Yes, and that one that are used in what we call the fair value input of measurement. You'll discuss that one in advanced level. Another thing is a reconciliation between the carrying amount of revaluation surplus at the beginning, at the end of the period, that is indicating the movement of balances. Good. Then we have financial instrument. Have you discussed on financial instrument? What's a financial instrument? Yeah, that's under IFRS 9. So you can discuss that for 1 minute. Give me a minute. Based on your discussion, what's a financial instrument? Hmm? I didn't say you read what's written there. There you cannot understand anything. Eh? No, these are standards. Hmm? For you to understand a standard, a standard is like a constitution. You can be able to read it, but you cannot be able to interpret it. It only takes a lawyer to interpret as a given act for you. Now, a financial instrument is a contract which gives rise to an asset to one party and a liability to another party. It is a contract which gives rise to an asset to one party and a liability to another party, e.g., equity or share, loan, debenture, bond, cash, receivables, etc. If you take a loan from the bank, the loan to you becomes a what? A liability. What about the bank? An asset. If you deposit 100,000 to the bank, we are assuming, you deposit 100,000 to the bank. That 100,000 to you becomes a what? An asset. What about to the bank? To the bank, it's a liability. Yeah, actually, for the bank, we'll do that one in advanced financial reporting. When presenting the financial statement, the customer deposit to a bank is a liability, but the customer is an asset. If you buy a bond from the government, you invest in government bond worth 1 million. 2 becomes a what? And as what about the government? A liability. If you buy shares of a company, 2 becomes a what? An asset. What about the company? It's a liability. Yes, that's why you have equity and liability. Are you together? Mbona haziwekai kwa asset? You know, for the company, they include as equity and liability because the company has money here they are operating using, but this money does not belong to them. It belongs to the shareholders. Higher. If you sell goods on credit to another party, you become an asset, right? Because you expect to receive. That's why you record account receivable as a part of current asset. What about the other party that purchased? Liability. That's why the other party recognizes a credit purchase, which is part of creditors. Now, that's what we call a financial instrument. So it's a financial contract which gives rise to an asset to one party and a liability to another party. And we have various types of financial instruments. Now, financial instruments are classified into 4. Number 1, we have what we call financial asset. Yeah, financial asset previously used to be under IAS 39. But in the last financial year, this one has been fully scrapped. Now we have integrated to IAS 9. Then number 2, we have financial liability. Number 3, we have equity. And number 4, we have derivatives. Derivatives, this one includes options. We have what we call the forward contracts. Then we have what we call the future contracts. We also have what we call swaps. Most of this one is used in international trading, international financial management. Good. So what's a financial asset and a financial liability? I think we have explained the difference between the two. A financial asset is where the holder expects some future economic benefit. Financial liability is where the holder expects future what? Future what? Obligation or an outflow. Are you together? Liability, you expect future outflow. An asset, you expect future income. So now those are the 4 types of financial instruments. And financial instrument does not miss in most of the exams. So kindly you get a reason. So I want us to discuss on financial assets. We focus on financial assets. Now, financial assets, this is where the holder expects cash or expects some future benefits. And they were classified into 4. That's under old IAS that 9. Financial assets were classified into 4. So first of all, let me discuss about them. Number one, we had what we call the financial asset at fair value. Also, there was what we call available for sale financial asset. Number 3, there was what we call held to maturity. And then number 4, we had loan and receivables. Forget about that because now the standard has changed. Now, under the new standard, all the financial assets are classified into 3. 1, we have what you call the financial asset at fair value through other incomes or through other income or through P&L account. Number 2, we have financial asset at fair value through OCI, through other comprehensive income. That's what we call the OCI. And number 3, we have financial asset at amortized cost. Yeah, those are the 4 classifications of financial assets. Now let's operating. Everything is on the notes. I want to explain the 3 because there is some similarities. Now, financial asset at fair value through other income or through P&L, it was initially was called financial asset at fair value. And what are those? Now, those are short-term financial assets, such as treasury bills. Treasury bills, yeah, that means they are held for trading purposes, or you expect to receive the economic benefit within 1 financial year. That's what we call the financial asset at fair value through P&L or through other comprehensive income, or through other income, sorry. Then we have on the other side, financial asset at fair value through other comprehensive income. Now, these are what we used to call them available for sale financial assets, AFS. And what are these? These are long-term in nature. Long-term financial assets, such as bond, debentures, all that. Also shares of a company. Then number 3, there is financial asset at amortized cost. Now, financial asset at amortized cost purely comprise of the debt assets or debt component. Debt component such as debenture, such as loan with a given maturity period. Equity does not fall under that. So financial asset at fair value through other income, they are short-term financial asset. Financial asset at fair value through other comprehensive income, they are long-term financial assets, also known as available for sale. Then financial asset at amortized cost, they are also long-term asset, but they only comprise of the debt elements, debt component or the debt element. Another difference between the 2 is that, or between the 3 is that, financial asset at fair value through other income, since they are short-term, the fair value changes are recognized to P&L, to profit and loss, or what we call other incomes. In case of fair value for financial asset at fair value through other comprehensive income, these are long-term assets. Their fair value changes, you recognize them under other comprehensive income. To other comprehensive income. And remember, explain the difference between other income and other comprehensive income. What's the difference between the 2? Other income, you recognize them under gross profit. Are you together? Other comprehensive income, you recognize them under other assets. Below assets. And not capital. Let's go to the income statement. We are seeing the income statement. We're talking about the fair value gain. Other income under gross profit. What about other comprehensive income? Below? Net profit, correct. after the profit after tax. Profit after tax. Yeah. Once you have the profit after tax, you add other comprehensive income. And anything that goes to other comprehensive income, anything that you indicate under other comprehensive income, you also take it to the part of equity as part of reserve. That's what we call a revaluation gain. Yeah, such as actuarial changes and revaluation gain of PPE. Good. And then financial asset at amortized cost, also their gain or loss, they should be recognized to other comprehensive incomes. Good. Now let's go back to our notes. Financial instrument and IFRS 9, we have definition of term. What's a financial instrument? A financial instrument is any contractual contract that gives rise to a financial asset to one entity and a financial liability or equity instrument of another entity, e.g. loan, debentures, bond, cash, etc. Another definition is financial asset. What's a financial asset? It's any asset that is, number one, either cash, number two, contractual right to receive. Can you underline that? Contractual right to receive. Contractual right to receive cash or another financial asset from another entity on condition that are potentially favorable. Then another one is a contract that will or may be settled in an entity on equity and then an equity instrument of another entity. Just answer the first two, yes? You are lost. Why are you lost? Sasa the handout you are using here, hii handout nilikuwa nimetengeneza 1995. I have explained something that the standard changed, right? If the standard changed, mkienda holiday, mimi naendaka holiday hata mimi hapana. Mkifanya exam mimi naendaka holiday. But you see, that's the best time for me to do research. I'm a good researcher. When a standard changes, I have to do a deep research. Like the one we did for, so we did accounting for leases. The accounting for leases, all the markers cast-name. I was the only one with the notes. I was the only one who was able to research and to determine how they were supposed to be accounted. So nyinyi mkienda break mwalimu wenu anadai kulala, anaenda kufanya research juu yenu. For those who are using the handout that I had shared recently, the updated one, nime-update kila kitu. So you are 1995 years to me. Yes. Yes, mkiona hizi notes zangu, yes, I always actually this handout. That's why the PDF. I usually do. I'm a good researcher mostly for anything to do with finance, economics, also tax. Yeah. Hizo nafanyanga sana. That's why I might understand the economy better than you do. Yeah. You might understand the economy 1%, but understand it 90%. Yeah, because I'm a very good researcher. Hata mimi huwa nasomanga. Ama mjui hivyo? Hamjui hivyo nasomanga? Yes, ni vigumu nipate na kitabu lakini mimi nasomanga sana. Sana. So me I utilize the social media. Kila kitu iko kwa internet. Kila kitu iko kwa internet. You go there, vitabu ziko mingi sana. Nyinyi mnafanya research wapi? TikTok, right? That's a fact. Yes, because that's why you do your own research. Anything to do with memes, you're mnakuwa updated. And I Twitter, but for me, yeah, I like doing things too on where will be in the next 10 years. Sorry? Zango mwezani nazo. If you read something that have been done by me, you'll be shocked. Because why do you expect to be 10 years from now? I mean the world. What is the world heading? Hizo hamjui. Mnalive for the current. Yes, by the way, if you do that, can you start researching? So know where our world is going. Actually, nowadays, based on the global trend, the world is changing very fast. Very fast. Yeah, in the next 2, 3 years, 4 years, I'll not be here. Let's meet, to be honest. Umalize haraka. For the next 2 or 3 years, I'll not be here teaching. Most of the work mnafanya, si nyinyi mtakuwa mnafanya. Hiyo hamwezi elewa because you don't do research. Then some about artificial, the AI, how how it's going, eh? Yes. Itakuja kureplace kazi zenyu zote. And then you see most of us, we are doing what others are doing. Copy pasting. Yeah. Nowadays you need to be innovative. Do what others are not doing. Before wengine wakuja kuduplicate, you're already a millionaire. Eh? Eh? And you see, when you now start getting money, opportunities start coming. True or false? Yes. That's why you see a rich person. They always discuss business. Poor people, they discuss poverty. True or false? Yeah? So the world is changing. Nowadays, let me tell you one thing. I might advise you. Nowadays, kuna online courses, even for international universities. Usiende karatasi. Nowadays, kuna watu wanakuja wananiambia, "Teacher, mimi nataka tu nipate karatasi." That's not what we are headed. Nowadays, karatasi does not, it means nothing. True or false? Yeah. Nowadays, it's all about what you can do. Even nowadays, interview mingi kama zile kuna one of my mentors anafanyanga interview. He's a very rich guy, eh? Akitaka accountant nini mimi anaitanga niwafanyie interview. Sasa nionyesha hapana, haangaliangi makaratasi. Nakwambia kawaita wawili tukwenda hivi. Mnatembea for 30 minutes. Mkiongea. That's how we do the interview. He does the interview. Hata mimi anionyesha mambo ya makaratasi achana, naweka karatasi kando. Nakuulizanga swali rahisi, what's an asset? So with your masters, with your what, that one is nothing. Are you together? Yes, nowadays tunataka kujua how better can you perform. It's about how you are performing. Sio karatasi sana. Eh? Because nowadays, hebu angalia most of the unemployed people who are employing themselves wanakuwa rich quicker than watu wamesoma tunakaa pale kwa ofisi tunazunguka na kiti. Innovation. Because wanakuja na vitu zingine watu wengine hawana. Anaenda social media na advertise. Nowadays even marketing. Nowadays we have a global market. Sio kama kitambo. For now we have a student from Rwanda wananisikiza hapa. From Kisumu, from Mombasa. It was due to COVID. True or false? There was a challenge. What did you do? You created a solution. So if you create a solution, that's all. Kuna kitu ingine. The world sasa inakuwa just one market. Sasa kama ingekuwa pre-COVID, wewe ulikuwa unajua Zoom ni nini? Now you used to know what's the Zoom, right? So as a student, you have to go to class physically. What about someone who is in Shamahoho, who cannot be able to access school? So nowadays, can you do a lot of research? Then take online courses. More on the code technologies. Are you together? This technology inakuja kureplace kazi zetu. Wacha nimwambie ukweli. And that's the fact. In the 10 years to come, hautakuwa the same place. So start investing now. Nasema muinvest kwa maso. Na si easy, just certificate. A course that will take you only 2 months, 3 months, 4 months, 5 months. Haya, tulikuwa tumefika wapi? Financial instrument. I mean financial asset. Then the third one is the financial liability. Now let's go to page 23. Page 23. Now in page 23, I want us to look at the measurement and recognition of financial instruments. Measurement. A financial asset or financial liability should be recognized in the financial statement, a statement of financial position, when the reporting entity becomes a party to the contract. Now, let me repeat something. We say that recognition criteria for an asset, number 1, an entity must own and control the asset, expect some future economic benefit, and number 3, the value can be measured. That's the recognition criteria for an asset. What about for financial instrument? So that you should recognize a financial instrument when, that's what I'm explaining there. We go back to the notes. A financial asset or financial liability should be recognized in the statement of financial position when the reporting entity becomes a party. That means can either be a liability to you or be an asset. That's when you should recognize. When the reporting entity becomes a party. Good. So we proceed. Now we are looking at the initial recognition. Now, actually, all the financial instruments, be it a financial asset or financial liability, the initial recognition is always the same. They should be recognized at fair value. So all the financial instruments are initially measured at fair value, plus or minus changes in fair value, either through the profit and loss account or through other comprehensive incomes. Now, let me explain here. Just listen here. I think that all financial instruments initially should be measured at what? At fair value, with the changes, that's what we call plus or minus, with the changes in fair value, be recognized either to P&L or other comprehensive income. That means if in case it was a fair value gain or loss for financial asset at fair value through other income, that fair value changes you take it to the P&L, in short, under other income. In case was a fair value gain or loss for long-term asset, you recognize it under other comprehensive income. We go back to IAS 10, and not IAS 10, IAS 16 and IAS 40, financial investment, property, and PPE. How do you measure assets initially? Article? Good. All the other tangible assets, initially they should be measured at cost. But from financial instruments, initially they should be measured at what? Fair value. At fair value. Then subsequently, all the financial instruments should be measured either at fair value through other income or P&L, or through other comprehensive income, or at amortized cost. Amortized cost. Subsequently, all the financial instruments can be measured either at fair value through P&L or financial at fair value through other comprehensive income or at amortized cost. Yeah, we did here leases, and this is that we amortize the liability. So that means for amortized cost, we only use for the debt component or the debt instrument only. Good. We repeat again. Now listen up here. All financial assets, financial instruments are initially measured at what? At fair value, either through P&L or other comprehensive. Yeah, that one depends whether it's a short term or long term. If it's a short term, you take it to the P&L, that means under other income. If it's a long term, you take it to other comprehensive income. What about subsequently? Do you hata sijafuta hapa? At amortized, it's either at number one, fair value through P&L or other comprehensive income, or at amortized cost. Amortized cost, and that's all. Then look at the recognition of financial instrument. The recognition. What is the recognition? Remove all together. When can you remove a previously recognized financial asset or liability from financial statement? When it's obsolete. That is of asset. Are you together? We're talking about the financial instruments. Sorry? When it's matures. This is what I mean. If you invest in government bond for 4 years, what will happen after 4 years? It will mature. That means the government will give you back your money, right? So that means once you get the money, do you expect any future economic benefit? No. So what will happen? You will derecognize from the financial statement because it's no longer an investment, because you don't expect any future economic benefit. So that's one of the criteria for derecognition of financial instrument when it matures. That means there is no contractual right to receive any further benefit. Another one, full settlement. Correct. Because when it matures, that means you have paid interest and the principal, right? When the ownership changes, correct. If you had bought shares of a given company and then decided to sell it to another person, so what will happen? It's no longer your investment again. So you have transferred the share. So now what happens upon now the disposal or transfer of ownership? If you had shares, so automatically that one now you'll be recovered from the financial statement because it's no longer your asset. You have transferred the right to receive the benefit and the risk to another party. Actually, those are the major two criteria for the recognition of a financial instrument. Number one, on maturity, and number two, when the transfer of the ownership or disposal good. So let's discuss that in handout page 23. The recognition of financial instrument. Now, the recognition is the removal of previously recognized financial instrument from an entity balance sheet. A financial instrument should be recognized if either the entity contractual right or asset cash flow have expired, right in bracket, maturity. Maturity, and number two, the asset has been transferred to the third party along with the risk of ownership. So transfer of ownership. Good. Then there's another point there. If the risk and reward of ownership have not passed to the buyer, then the selling entity must still recognize financial instrument and treat any consideration received as a what? Liability. I told you that these are a standard. Is that like a constitution? Sasa hiyo ni act. Umeelewa nini hapo? Read it again. Just read it again. Have you understood? You are saying something. When the ownership has not been fully transferred to the buyer, you have to recognize liability. Sijasema unisomee kenye imeandikwa hapo.
My understanding is if, for example, you are not fully transfer the shares, if there are any difference you receive, you will be holding them on behalf of the person.
Correct. Correct. This is what I mean. So you are taking company role, right? When do you become, what's the difference between a shareholder and a member? Aman is spelling. What's the difference between a shareholder and a member? A shareholder have subscribed, eh? What about the member? Is that? I'll call Mr. Peter here. A shareholder. Akona equity, eh? Equity is your shares, eh? That's the shareholder.
And there's a one they transfer the shares, but jina yake haijatolewa kwa members.
Members register, right? You umeelewa ama mjaelewa?
You cannot exercise the powers of a shareholder. You cannot vote, you cannot get the dividends simply because and the transfer is her shares, but bado jina yake
has not
been removed.
Has not been removed, eh? Okay, you are correct somehow, but a member is also a shareholder, right? No, a member is also a shareholder, or a shareholder, but a shareholder can be a shareholder, but not a member. True or false? Also, a member can, that's what I'm saying, eh? A member can be a member, cannot be a shareholder. Are you sure? Okay, that's therefore, what's the difference between a shareholder and a member? That's what I'm asking. Okay, now let's go back to the financial reporting before I call Mr. Peter here. Now, this is what happens. Assuming that I had 1,000 shares, I was holding these shares, and then I transferred them to another person. But now the transfer, the share certificate still reads my name. Are you together? So who will receive the dividend? It's me. Are you together? But in this case, I have already sold my share. So that means once I receive the dividend pertaining to this, that dividend does not belong to me. It belongs to the other party. But I'm the one who have received. So I'm holding the money that does not belong to another party. Therefore, I show them as a liability. Hivyo ndivyo inamaanisha. So now let's look at classification of financial instrument. I think I explained everything. So that financial instruments are classified into 4: financial asset, financial liability, equity instrument, and derivatives. Then we have classification of financial assets. See that financial assets are classified into 3. We have financial asset at fair value through other income, financial asset at fair value through other comprehensive income, and then financial instrument at amortized cost. I mean financial asset at fair value at amortized cost. Now let's start with the first one. Now, financial asset at fair value through profit or loss or through other income. This classification includes any financial asset held for trading purposes. Can you underline that? Held for trading purposes. That means they are short term. Yeah, right in bracket, short term. In bracket, short term. Yeah. Then how do we measure them? We have initial recognition. Initial recognition at fair value. Can you underline fair value? Okay, let me not discuss about recognition because it's that all the recognition are the same. Initially recognize them at fair value with the changes. Now, like this one, you recognize it at fair value with the changes taken to the P&L because they are short term. The other one, initially should be measured at fair value with the changes reported to other comprehensive income. Good. Now let's go to the second one. Financial asset at fair value through other comprehensive income, right in bracket, available for sale asset, like that. Available for sale asset. That's what we call AFS, available for sale asset. Now, it will typically be applicable for equity instrument that an entity intends to retain ownership on a continuous basis. You expect to retain the ownership on a continuous basis. That means it's a wrong term, right in bracket, wrong term assets, Then number 3, we have the financial asset measured at amortized cost. So now I want you to listen here. Now for the financial asset at amortized cost, mostly they are wrong term. But what makes it to be financial asset at amortized cost, but not at through P&L? I mean through other comprehensive income. Now, for example, if you have a equity share, equity is financial asset at fair value through other comprehensive income. If you have a debenture, this one is a debt instrument. Debt instrument would be financial asset at amortized cost. One party, the company that invested. Also, in case you have a bond. What if now this debenture was redeemable debenture or convertible debenture? What's a convertible debenture? Is a debenture that converted into ordinary share? Yeah. Now, in that case, it does not qualify to be a financial asset at amortized cost. It will qualify to be a financial asset at fair value through other comprehensive income, provided it's what we have what we call the compounding instrument. Now, compounding instrument is an instrument whereby it has both equity element and there is debt element. Yeah, for example, a convertible debenture, convertible preference share. That if it can be converted to ordinary share, there is an equity element. But itself, it's a debt. So that's what we call a compounding instrument. Now, compounding instrument does not qualify to be measured at amortized cost. Only that one will be included to the financial asset at fair value through other comprehensive income. So for it to qualify to be financial asset at amortized cost, they must meet 2 criteria or 2 tests. Now let's go through that. This classification can be applied only to debt instrument. Can you understand that? Debt instrument. It must be designated upon initial recognition. For the designation to be effective, the financial asset must pass 2 tests as follows. 1, the business model test. To pass this test, the entity must be holding the financial asset to correct its contractual cash flow. Can you understand that? To correct contractual cash flow associated with the financial asset. Now that means investment in government bond or debenture so that you can be receiving interest. That means the interest is the contractual income. Then you're saying that if this is not the case, such as financial asset being held and then traded to take advantage of changes in fair value. If this is not the case, such as the financial asset being held and then traded to take advantage of changes in fair value, then the test is failed. If you hold that asset, then there is another party that's giving you a better offer you sell, that one does not qualify to be a financial asset at amortized cost. For it to be amortized cost, the contractual arrangement is that you have to receive the interest, then upon maturity, you get full back your money. If you trade it between the maturity period, that one does not qualify to be measured as financial asset at amortized cost. That's what we call the business model test. Number 2, the cash flow characteristic test. To pass this test, the contractual cash flow corrected must consist solely of payment of interest and what? Capital. Capital means the initial principal. Good. If this is not the case, the test is failed and the financial asset revert to default classification as measured as fair value through P&L. One example of financial asset that would fail this test is convertible what? Bond. Can you understand convertible bond? I think I explained what it means by convertible bond. Then there is impairment of financial asset. You go through that. Yeah. Now let's go to page 26. Page 26 there is fair value hierarchy of input measurement. What do you mean by fair value? We said what is fair value? It's the market value, right? Yeah. So now let's look at fair value hierarchy of input measurement. Fair value hierarchy recognizes the input used in valuation technique into 3 levels. Level 1 is level 1 input. That's the quoted prices. If you want to buy a piece of land, first thing you ask the seller, how much are you selling this land? For being 4 million. That's what you call the level 1. You look at the current market value. The seller is offering that property. They're saying that level 1 input are quoted prices in the active market for identical asset or liability that the reporting entity has an ability to assess at the measurement date. Then number 2 is level 2 input. Level 2 input are input other than the quoted prices, including level 1, that are observable for an asset or liability. You wanted to buy that piece of land. Remember, a quoted price is 4 million. Now that's level 1. Level 2, you look at other observable items. Kama nini? Kama social amenities, right? Kuna shule karibu, barabara. That's the infrastructure, right? Also trees. Does tree influence the value of land? Sorry? You can find the trees after you buy. What if now there is a tree? Does it influence? Yes. Also, whenever there is a compensation by the government, maybe they want to construct a road. Another factor, in case there is any tree, they give it a valuation. So that means a tree also increases the value of the land. That's level 2 input. Then level 3 input. Level 3 input are an observable input for the assets or liability. Now, in case, assuming you're the one you want to settle somewhere, how might you be willing to settle? Na usiniambie Uasin ama Sugoi. You know, carrying the love kurudi kwa ushago. Ungependa kusettle wapi? Yes, in case you are to settle. Kitusuru, Haya. Your names are still valid, Kitusuru. Haya, number one, you have looked at the market price of the piece of land. Number two, you have looked at what you call observable item. Then what are other unobservable things you look? Security. Yeah, by the way, security falls under that, Yes, security. Watu kuwa ananyongwa sana, Kitusuru kuna wizi. Ama Karen. Sio sana. You know why? Why is the reason? The crime rate is very low in posh areas. I'm just doing a research. The crime rate is very low in posh area where you have rich people. The centers of power, number one. Another thing. You know, there was one thing I was applying for something. Now, for example, if you want to apply for, okay, this is what I mean. If you go to Karen, by the way, you know, for a thief, you can assess someone ako kwa Mercedes Benz yake, unakuja na panga, then unapata yako na bunduki, true or false? True. By the way, for okay, do you know the gun regulation in Kenya for you to get a private guns? What are the requirements? Na mbona huwezi kaa na watu sana sana ama in a residential place sana sana? That's one thing they have to look for. Sawa. Then before they look at your wealth status. So you look at most of those people live in posh area, they are private gun holders. Sasa utatoka Kayole. I hope you are getting what I mean. Also, there is restricted access, true or false? Even you have some places you cannot go with a motorbike, not unless it's a sport bike. Hata gari sometime wanaangalianga, unasimamishwa mara kama 10 before access to that place. Also, they have their own welfare. So anyone working in that area, lazima ukuwe na license. Also, construction, you must be approved by the resident. Huko nuisance, even kuweka church huko uanze kupigia watu kelele, for them will be taken to court. Yes. On a Sunday unaweka volume juu, the way tumezoea huko kwingine. Yeah, to them that one is a crime. Waitua polisi haraka. Also they pay for security fees. Yeah, that means in case there is an emergency, the response time mali unaishi na mali wao wanaishi. Which one is faster? Yes. So you look at number one was security. Those are unobservable. Also look at the weather, right? Yeah, we have some people with some condition. They can live, they cannot be able to live in a certain place, maybe due to the weather condition. Kuna place inakuanga baridi sana, majoto iko juu sa? Yes, those are some of the factors you consider. I hope now when you are tested about the fair value input, mwesikiza stories zangu then muanguke. Yeah. How many input do we have when measuring for fair value? 3. Number one is what? Level 1. Okay, what incorporates level 1? The quoted price. Number 2? Other observable. Input 3? Unobservable. Good. So we can take a small break, then we come and then we proceed with other assets of liability. I told you that these will account between 20 to 35 marks of your exam. Let's proceed. Look at IFRS 6. Now, on page 27, look at the exploration and evaluation of mineral resources. That's under IFRS 6. So accounting for exploration and mineral resources. Now, the scope of IFRS 6 states that an entity shall apply the IFRS to exploration and evaluation expenditure that it incurs. Number 2, an entity shall not apply the IFRS to expenditure incurred before the exploration. Now that means that will be treated as preliminary expenses. Now let's look at key provision on impairment of exploration assets as per IFRS 6. Now that one we'll discuss because you won't understand anything. It's a very complicated standard. The most recent also adjusted standard, IFRS 6. Also the disclosure requirement, all that. Also the recognition. Let's go to handout page 28. Departing from the application of IFRS, IAS, or IPSAS. Departing, what do you mean? Now look at the disclosure requirement. Now departing, that means that a given standard requires you to maybe to account or recognize an item in a particular way, but the management decided not to apply. So what are those disclosure requirements, or when are those circumstances when an entity might depart from the application of IFRS or IAS or IPSAS? Now, disclosure requirement. When an entity departs from the requirement of the standard, the accounting policy, the accounting policy are created by the company, right? But standards are universal. Actually, they are uniform. I think that when an entity departs from the requirement of the standard in accordance with the paragraph 3, it shall disclose. What do we disclose? 1, that the management has concluded that the financial statement present fairly the entity financial position. In short, the management must give a guarantee that the financial statement presented, they are fair. Then number 2, it has complied with the applicable IFRS, IPSAS, IAS, except that it has departed from a particular requirement to achieve a fair presentation. Also, it must write a commitment that they have complied with all the other standards, except maybe one standard that they have departed from. Another one is that they should disclose the nature of the departure, including the treatment that the standard would require. And then number 4, the impact of the departure on each of the items affected in the financial statement. Now, those are the disclosure requirements in case the company departed from the use of applicable IFRS or IPSAS or IAS. Then we have accounting policy choices that are disallowed under the SMA standard. I will discuss that. Also, you have borrowing costs. What are borrowing costs? Borrowing cost, IS 23. That one we discussed in our last session. When I was discussing accounting for cooperatives. The last part I did was the borrowing cost. Now, these are costs associated with borrowing. As simple as that. That's what we call the borrowing cost. Costs associated with borrowing, such as interest and flotation costs that an entity incurs in connection with borrowing. Borrowing cost is directly attributable to the acquisition, construction, or production of a qualifying asset. Can you underline that? Qualifying asset. Qualifying asset. Now, let me explain something. If you take a loan, maybe to construct something or to buy something, now that asset you buy using a borrowed loan is what you call qualifying asset. You need to understand that if you borrow an amount to construct or to buy an asset, that asset is what you call the qualifying asset. They should be capitalized. Other borrowing costs are recognized as an expense. Now, for those who attended that class, how do we account for borrowing costs? Number 1 is that borrowing costs, they are expensed and other borrowing costs should be capitalized. And that means if you borrowed 4 million, maybe to construct a house, but remember you won't pay back 4 million. You'll pay inclusive of what? Of the interest. Now that interest, number one, you are expensive, and then you also need to capitalize. Assuming that this will attract an interest of 0.8 million. So in this case, when recognizing the value of the house, you will show the 4 million. Remember, you borrowed 4 million to construct a house, of which that house consumed 4 million. But on top of that, you paid the interest on that borrowed amount. Now, this cost, the borrowing cost, they need to be capitalized. That means when showing the value of the house, it will not show 4 million, rather it will show 4.8 million. That's what we mean by capitalizing. Good. So what are examples of borrowing costs? Number one, we have interest on loan or borrowing, flotation costs. What are flotation costs? What are flotation costs? Sorry? Cost associated with acquisition. Cost? Cost? Cost incurred when selling shares. Sorry? Yeah, we see that is the cost incurred in the process of raising new capital, whether it's the issue of new shares, also debt. When raising debt, there is some cost to incur. Maybe there are document processing costs. You need to hire a lawyer to prepare those documents. That's what we call the flotation cost. The cost incurred in the process of raising additional capital. That's what we call the flotation cost. Also, number C, there is borrowing the principal amount. Number D, there is amortization of discount or premium relating to borrowing. Also, exchange differences in case of foreign currency transaction. Yeah, sometimes you can borrow in dollars, but remember you require this amount in local currency. And then there is that exchange rate fluctuation. It can be an exchange gain, can be an exchange loss. Now, those movements also affect the borrowing cost. What's a qualifying asset? What's a qualifying asset? Is there? Asset acquired using? Yeah, the borrowed amount, correct. Yeah, a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale, or the asset acquired using the borrowed amount. What are examples of qualifying assets? I have listed them there. Now let's look at accounting treatment and recognition of borrowing costs. An entity shall capitalize the borrowing cost. Can you underline that? Capitalize. An entity shall capitalize the borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset as part of the cost of that asset. That will mean by capitalizing. You add that cost to the value of that qualifying asset. Then number two, an entity shall recognize other borrowing costs as an expense in the period in which it incurs them. Now, for example, interest, you capitalize, also you take it to the income statement as part of the interest on borrowing. Good. Now let's look at provision, contingent liability, and contingent assets. What's a provision? Provision, contingent liability, and contingent asset. Now, a provision is a liability of uncertain timing or amount of event. Can you underline a liability of uncertain timing? Liability of uncertain timing. And that's why we make provision for doubtful debt. The provision for doubtful, you might not expect. It's all about that uncertainty, of which it's always unfavorable. And whenever something is unfavorable, becomes a liability. When the provision is favorable, becomes an asset. Are you together? Yes. Now, recognition of a provision. When should an entity recognize a provision? A provision should be provided and recognized as a liability in the financial statement when, number one, An entity has the present obligation as a result of past event. Number two, it's probable that an outflow, can you add an outflow? A liability gives rise to an outflow. Yeah, when it's probable that an outflow of resources will require to settle the obligation. Also, number three, a reliable estimate can be made of the amount of obligation. That means the obligation can be measured reliably. And then when the probability of occurrence is more than 50%, can you underline that? 50%. Yeah, actually, that's the key provision, that when for you to recognize a provision, the probability of occurrence must be more than 50%. If it's less than 50%, that one we recognize as a contingent liability. More than 50%, a provision, and therefore should be recognized in the financial statement as a liability as well as an expense. What is a contingent liability? Discuss that. It's a possible obligation. Can you write possible? Yeah, it's a possible obligation that arises from the past event and whose existence will be confirmed only by the occurrence or non-occurrence of uncertain future event, not wholly within the control of the entity. Tusome tena. It's a possible obligation, so you have to mention that it's an obligation. It's a possible obligation that arises from the past event and whose existence will only be confirmed by either the occurrence or non-occurrence of future uncertain event, not wholly within the control of the entity. E.g., okay, if an obligation is probable, that means when the probability is more than 50%. If the provision, if the obligation is probable, it's not a contingent liability. Instead, a provision is needed. I mean this. If something is probable, you can be able to estimate with the reliance. That means more than 50%. That's provision. If the probability of occurrence is less than 50%, that means it's not that probable. It becomes a contingent what? Liability. A provision recognizes a liability, but for contingent and contingent assets and liability, they are not recognized in the financial statement. They should only be disclosed. What an example of contingent liability? Now we are saying that it might lead to future outflow of it's an obligation which arises as a result of past event, whose occurrence will be confirmed or whose existence will be confirmed either by the occurrence or non-occurrence of and future timing not wholly within the control of the management. For example, a warrant or a pending legal case. So you know what's a warrant? If, for example, if you buy a phone, a new phone, so you're given a warrant, maybe 1 year or 2 years. What does it mean if you're given a warrant? Assuming I'm the seller, I sell to you a phone, and then I give you a warrant of 1 year. What does it mean? In case there is what? In case there is default within 1 year, you can bring back the phone. We repair. In this case, I'm the seller, right? So now, to me, that one is what we call a contingent liability. I have already sold good to you. So that means it arises as a result of past event. Now, in case you bring back that asset, I'm the one to repair. Is it an inflow or outflow? An outflow. But you see, in that case, I cannot estimate the probability of occurrence because you might come, you might never come back. So it will only be confirmed by the occurrence or non-occurrence. Also, a legal pending case. A legal pending case. Now, in a case, there is two parties. There is who and who? Plaintiff and defendant. Now, assuming that in this case, you are the defendant. Defendant in the mshukiwa. Ama ni plaintiff. Eh? Is there? Sasa agree part sasa umeharibu zaidi. Haki na wataelewa ni nini? Defendant and plaintiff, eh? Nani mshukiwa? The defendant, correct. Now, assuming that now you have been taken to court. So that means in this case, you are not sure about the judge outcome, true or false. It will only be confirmed either by occurrence or non-occurrence. Now, since we're the mshukiwa, So high chances there might be an outflow expected to settle that. So that's why it's a contingent liability. Then we have contingent assets. Now, contingent asset is the opposite of contingent liability. But in this case, you expect to receive. All right, now let's go through that. Now, we are still in contingent liability. Let's go to the last sentence. If an obligation is probable, it's not a contingent liability. Instead, a provision is needed, e.g. warrant, legal paid in case as a defendant. Contingent liability shall not be recognized, but shall be disclosed. Yeah, for contingent assets and contingent liability, they are not recognized in financial statement. They should only be disclosed. What does it mean? The difference between recognition and disclosure is that recognition, for example, provision, it will affect the financial statement. It will go to the balance sheet as part of liability. Contingent liability will not affect the financial statement, will only affect the notes to the financial statement. You tell the shareholders, yes, there is one of our competitor, we breached the contract. So we have a legal pending case. That's what we mean by disclosure. But that won't affect the financial statement. Good. Then we have contingent asset. A contingent asset is a possible asset that arises from the past event and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain events. E.g., pending legal case as a whole. As a plaintiff. Yeah, as soon as a plaintiff, you take another party to the court. So you expect that the other party might rule in favor of you. So that means you receive the damages. If you receive, it's an asset. But the other party paying the damages is paying, so it's an outflow. Therefore, becomes a liability. Good. Also, a contingent asset shall not be recognized, rather than shall be disclosed. Good. Then we have accounting policy changes and estimate. So I'm tired. You know, I'm talking too much. You know, I don't like discussing theories. I like doing computation. Sasa hiyo ni kupiga kelele peke yake. You know, computation ningekuwa nimefanya swali nampea break mkope. So that's why we'll start in our next session. Yeah, we discuss on accounting policy changes. And then before next session, what we have discussed, can you go and discuss them again by yourself? So go through them. That's why I was telling you to write something. Because I insist again, between 20 to 35 marks. So kindly this handout uko unasoma karibu kila siku. Because ukishika hii na ufanye another one topic, si umepita? Kama mshiki hesabu, kama mshika hapa chase. So I think now will be your saver now. So go through this. Yeah, so go and revise on accounting for assets and liability. Also, not just 25 marks, because the next topic will always be based on accounting for assets and liability. You see the small topics I did. Accounting for leases, accounting for income taxes, the borrowing costs. Now, the next topic, which must be tested, like it is usually it's called published financial statement. Last sitting, they tested 2 questions. 2 questions. Na hiyo kufanya swali moja, it can even take 3 hours. Kufanya 1 question. Now last semester they tested 2 questions. Lakini moja wakabia student ni partnership, but it was not a partnership. It was a published. And that one borrows the concept of all the other topics you have done. So kama haujashika hizo topics zingine zote, high chances you might float for the coming topic. So once I could revise as early as possible. Yes, it's all about the standards. And then how do the company prepare one published financial statement ready for publication? It's like a summary. So that's what we'll be discussing. So first of all, we'll wind up on the accounting for assets and liability. And then I give you some notes on published financial statement, which might take us the next 2 classes. So we can call it a day. And then